The question here is how do you spot a stock that is trading at below its intrinsic value? How do you spot or recognize a stock selling at below its intrinsic value? So in this case, you consider number one, introduction to value stocks. Introduction to value stocks. So value stocks are companies that are perceived to be undervalued by the market relative to its intrinsic value, often trading at a lower price than its true worth. They tend to trade at a lower price than their true worth. These stocks may be overvalued or may be overlooked or ignored, by the markets, or temporarily underperforming, creating potential opportunities for investors. These are neglected stocks, disregarded stocks, stocks that encounters and that are encountering temporary kind of misfortune, and it might, presents a buy opportunity for value investors. Number two, key metrics for identifying value stocks. What are the key metrics that could be used to identify value stocks? Number one, you use the PE ratio. The PE ratio, compared to the industry peers or the market average, can indicate whether a stock is undervalued or not. You calculate the PE ratio and then compare the value with other stocks in the same industry, or you compare it with the industry average. And so this should be supported by companies' fundamentals. So you may consider price to book, the price to book ratios. Price to book ratios compare the company's market price, to its book value. The book value is the company's net asset value. So a ratio below 1, often signals that the stock is undervalued, as the market is pricing the companies lower than its tangible assets, and a value above 1 shows that the company is overvalued. So you also take into consideration price to sales ratio. So a lower price to sales ratio suggests that the investors are paying less for each dollar of the company's sales, which can indicate undervaluation. The investors are pricing each dollar of the shares lower than what should be expected. So you may also look at dividend yield. Value stocks often pay dividends, so a higher than average dividend yield may signal that the stock is undervalued. Though it's important to assess whether that level of dividend is sustainable. Is that dividend level, is it sustainable or not? If it is sustainable, it shows that yes, the company is truly undervalued. Number three, analyzing the company's financial health. Analyzing the company's financial health. So in this context, you consider earning stability. Look for companies with stable earning over time. Value stocks typically have a proven track record of profitability. Even if the growth is slow, it may have slower growth, but if you look back, you discover that it has consistent earning over time. Then equally look at free cash flow. Companies with strong free cash flow, are in a better position to weather economic downturn, and also are able to fund their growth, which can make them more attractive. It makes them, better investment candidates. All right. It makes them, attractive investments. So if you don't forget debt levels, You consider debt levels. Check the company's debt to equity ratio. A company with manageable debt levels is less risky than, you know, than the ones with a higher debt level. That means that they are, likely to recover, quickly in the case of a market downturn, and they can recover quickly if the company is truly undervalued. Number 4, intrinsic value calculation. How do you really calculate? How do you calculate intrinsic value? This discount cash flow analysis. You may adopt discount cash flow analysis. Discount cash flow analysis estimates a company's intrinsic value by projecting, future cash flow into the future and discounting them to the present value. As if discount cash flow value is higher than the current stock price, it may indicate that the stock is undervalued. At the time you discount future cash flow back to the present time and the value is less than the current stock price, that stock is considered undervalued. You may equally use comparative analysis. So compare the company's valuation ratios like the PE ratios, the price to book ratios, the price to sales ratios to similar companies within the same industry or sector to see if the stock is undervalued relative to its peers. Please make sure that it is done within the sector. Don't compare companies from different sectors. It's like comparing apple with with pineapple. You don't do that. It must be within the same sector or industry. Please like this video and subscribe to this channel if you've not done that. Number 5 is qualitative factors to consider. What are the qualitative factors you could consider as an investor? You look at industry conditions. So in this case, you assess whether the company is operating in a temporarily distressed industry or facing short-term challenges. The stock may be undervalued due to external factors rather than company specific issues. So external factors can cause a stock to become undervalued even when the company's fundamentalism is okay. All right. You also, look at the management team. A strong and experienced management team can help steer a company, through difficult periods, potentially, leading to, the markets re-evaluating the company's, chance of recovery. The other item is, competitive advantage. Look for companies with a strong brand, unique products, or other advantages like a moat. This can lead to long-term, value creation, even if the stock is undervalued in the short term. When the company has competitive advantage, it has a moat around it, has a strong brand, and can adjust price without consumers reacting negatively, then that company is a very good candidate for investing. So you also look at analyst rating. You look at analyst rating. So pay attention to analyst reports and ratings. While not always accurate, they can provide insights into whether a stock is being undervalued by the market or not. All right. So you also look at market overreactions. Sometimes market sentiments, corrects to, they tend to overreact to bad news, causing a stock to become undervalued. So identify the situation involved, and understand the company's fundamentals before you know what next to do. Don't just base your decision on market sentiments or market overreaction. Look at the company's fundamentals. This is how this is how to to assess market sentiments as it relates to the company you want to invest in. Number 6, risk, to be aware of. What are the relevant risks you should be aware of? You should consider value trap. Not all low price stocks are value stocks. Some of them are facing fundamental issues like declining earning or serious, issues with the company's fundamentals. All right. You also look at longer recovery time. Sometimes it could take a long time for the company to bounce back to its true value. So it may take time for the market to recognize the intrinsic value of a stock, and during this time, the stock may underperform. So patience is necessary. So in conclusion, identifying value stocks involve using key financial key financial metrics like PE ratio, price to book, price to sales, as well as assessing the company's financial health and industry conditions, as well as intrinsic value. And so by focusing on undervalued stocks with strong fundamentals, investors can potentially benefit from the long-term capital appreciation, and once the markets reevaluate and recognize the true worth of the company. It might take time, but certainly it will surely come to pass.